Markets continue their climb higher, and the mainstream and orthodox continue to show that they are just thoroughly confused by what QE was, as discussions of Fed policy are picking up once again on the various social media platforms. So we're going to break everything down tonight. Before we do, make sure you get subscribed, turn that notification bell on so you won't miss anything going forward. Hit that thumbs up on the way out. All right. A real quick note on markets. I would love to come in with some major update, but really the most unremarkable rally we have seen in quite some time. We've recovered very nicely after the April tax drain, exactly as expected. Flows kicking back up here into the end of May. I do think we're probably a little overbought here. I wouldn't be surprised if we cool down soon, whether that is kind of an immediate sideways move, maybe for the next month, or maybe we continue to rally into June, into what is going to be a crucial point for that June tax drain. I think if we continue to rally into that tax drain, the June tax drain might make markets a little bit brittle here. Either way, little overbought, need to cool down, but longer term, I think by the end of the summer, as we head into the fall months, we will certainly be continuing to move into new uncharted territory, higher and higher. This is just an overall pretty bullish market here with very little standing in its way beyond just the very momentum of the market and the current rally. Very little to update there, steady as she goes. What I do want to talk about tonight, we're going to talk about in quite some detail, and I'm going to switch to the screen. So before I lose you, we are going to go over some balance sheets, but I promise if you stick with me to the end of this video, it will be worth it. We're going to talk QE, we're going to talk Fed monetary policy, the implication of monetary policy, and why MMT, in its unique perspective on monetary versus fiscal policy, why that MMT framework is so crucial to understand, why QE never did what policymakers thought QE was going to do, and also gives us a very informed perspective on why the last 2 years have played out exactly as they have. So let's go over these balance sheets. Like I said, stick with me. It's going to make sense at the end. The payoff will be worth it, but the only way to understand what's happening is to go step by step through balance sheet operations and understand what QE is actually doing. And once you understand what QE is doing, then you can understand why it failed at what it set out to do 15 some odd years ago, and why it was always the fiscal channel that was causing the growth or contraction that we would get. So what I have, and I posed this on Twitter recently, what I have is a world in which the private sector exists, but effectively there is no public sector at this point. So you have loans creating deposits, you have a private sector that has deposits that are on deposit at commercial banks, and the banks have the loans as the asset, and the private sector has the loans as their liability. And the private sector also has, in this instance, just some land, something material of value that could be sold, that a loan could be created to purchase to allow private sector bank activity to happen. What we're going to do is we're going to have the government buy the land, and how it is that they're going to pull that off. And what we're going to demonstrate is by the end of this, we will run QE and show that QE changes nothing materially when it's all said and done. So we're going to have the government buy the land. It's going to issue the reserves. It's then going to fund its spending after it issues the reserves with the issuance of bonds. And then we will run QE to show how the balance sheets change. The whole thought experiment here is just to prove out one of the core MMT points, that reserves are always the first step, both logically and temporally, in terms of the steps you have to take to issue the bonds. And once you realize that, you'll realize that QE is just reverting back to the initial logical first step that had to take place. So we have our public sector in red, we have our private sector in blue. Step one is that no government spending has happened. So step two is, now we want government spending to take place. The government is going to acquire the land. So now the Treasury has the land as an asset. And how it's going to do this is there's actually a handful of ways. If in the world that we have there are no reserves, the Treasury, the government, will just instruct the Fed to go ahead and make the transaction anyway. It'll instruct the Fed to go ahead and create the reserves, creating an overdraft at the Fed, at the central bank. So the Treasury will run an overdraft, and the central bank will just go ahead and create the reserves. that add to the deposits of the private sector, add to reserves of the banking sector. The government is then able to acquire the land. The private sector increases its deposits in its own bank by 100. The transaction takes place, and when it's all said and done, reserves had to be created to allow the transaction to take place. The way it's done in this instance is with an overdraft. This is where repos come in. The same thing can be done either way. It's the central bank momentarily creating the reserves to allow the transaction to take place. The transaction takes place, the Treasury gets the land, and now the private sector, before we ever issue any bonds, the private sector's net worth increases. In step number 1, the private sector has no net worth. In sector 2, in step 2, the private sector has net worth, which is equal to the negative net worth of the liability of the Treasury. So this is why in the MMT framework we say that the government spends, that when the government spends, it adds net financial assets to the private sector, or the whole sectoral balance approach, that the government sector's deficit is the private sector surplus, or another way you can put it is the net saving of the private sector is the spending of the government sector. This is shown in step 1. Now, this step happens effectively in concert with step 3, which is going to be the issuance of the bond themselves. I'll zoom in on this screen as well. So now the bonds, the treasuries, they have to get issued. That is a requirement that the government spend out of the reserves that it already has available, which is why it has to do either a repo or some sort of overdraft to get through that self-imposed constraint. It's important to point out that it's a self-imposed constraint. What ends up happening is the private sector, now that it has the reserves to actually absorb the treasuries that are being extended to it into the private sector, it can go ahead and do that. And what you'll notice is it is just a simple asset swap. Now, as an asset of the private sector is the treasury, the bonds that were issued by the Treasury. The Treasury is now able to resolve its overdraft, and the central bank now returns back to zero with no balance sheet. The Treasury still has the land, the private sector now has the bonds and the deposits, and the commercial bank returns to no reserves because those reserves were used to purchase the bond at the Treasury. Note here that the net worth remains the same. This is the important part. There is no substantial change after the first step of the spending takes place in terms of the position of the private sector. No new money in any real sense was added, unless you want to say that reserves operate in any functional way different than bonds. They're effectively the same thing relative to the most important part of what government spending is to the private sector. They are still adding to the net worth. And I'll make the case that the bonds are probably more valuable to the private sector, 1, because they pay interest, and 2, because they're a safe asset that the private sector can hold and will use to leverage its own loan creation endogenously. So the net worth remains the same. There is no material or substantial change between the private sector between step 2 and step 3 here once the overdraft is resolved. Now here's what we're going to do. We're going to go ahead and run QE. The Fed is going to step in. They're going to expand their balance sheet to take the bonds out of the private sector and put the reserves back in. So let's go ahead and take a look at what that looks like. The central bank now has the bonds that they purchased with reserves that they created. The reserves are now back in the private sector, and the reserves are now in the banking system, and the Treasury remains unchanged from step 3. Once again, let's note, the net worth of the private sector remains the same. The only thing that has changed here is the makeup of the assets in the private sector. All that has happened is they've swapped bonds for reserves. They've taken the reserves out, they've taken the bonds out of the private sector and replaced them with reserves. Notice that this is effectively the same as step 2 at this point, the initial step. What QE does is it just reverses step 3 back to step 2, but instead of the Treasury running an overdraft in place, the Treasury just effectively has spent out the bond into existence, and now the central bank holds it instead of the private sector. So there is no substantial change here. In no way can you say that this is truly monetizing the debt. The debt gets monetized in step 2 when the initial spending takes place. If you want to just simply define debt monetization as an asset swap between reserves and bonds, I'm fine with that. Go ahead. But there is no substantial change to the private sector, nor is there any change in its ability to conduct private sector loan creation. Everything remains the same from the private sector standpoint. So what we learn then is that QE is just a reversal of steps. It is just an asset swap that has no substantial change. Sorry to repeat that step, but it's important to drive it home between the private sector and the government sector. So let's drive home a few other important points here that we alluded to just a second ago. What is it that allows the private sector to create loans endogenously? One of two things, two things that both have to be true. Number one is the private sector needs income. The first burst of income is the initial deficit spending, when the Treasury spends to provision itself to pull assets out of the private sector into the public sector. That creates the first income stream, that creates the first flow. That flow then becomes the stock, which is the net worth, which is the second thing that is necessary for the private sector to conduct business activity, to conduct new loan creation. It needs capital and it needs income. And it's the first step the government actually spending that does both of those. QE is immaterial to that. It is only changing the composition. And in fact, I think QE likely dampens the ability for the private sector to create new loans. That's why we saw after the great financial crisis with QE and the massive expansion of the balance sheet of the Federal Reserve, very little loan creation. The credit cycles during that entire decade-long period were very muted from the historical norm. Now, part of that was probably the fact that we just went through the great financial crisis, and there was a lot of trepidation to want to extend new loans. The appetite for risk was low, but certainly QE in no way helped it when you look at just the simple balance sheet operations. The only thing that QE can really do is if there is a high amount of toxic assets in the private sector that the central bank wants to temporarily hold to ensure there's no liquidity crisis. Yeah, QE can step in and possibly help in that instance, and I won't negate the potential effect of various Fed operations for ensuring liquidity, but the liquidity risk is always only a shorter term risk. It is not in any way a risk of insolvency of the private sector that it does face when its net worth is removed because of higher taxes or something like that when the government goes into surplus. So yes, is there a place for something like QE to take care of any sudden liquidity crises that might emerge? Absolutely. I'm not saying that's not an important factor, but in terms of long-term economic growth, the sort of growth that propels asset prices higher, it is the government spending and the first step of that government spending that does everything that's necessary. Every step after that is immaterial to the first step of that government spending relative to the effect that it has on asset prices, with the one qualification that the Fed should step in the event of a liquidity crisis to possibly buy assets or allow asset swaps at a momentarily higher price to allow the clearing to take place, and then once that is resolved, allow the markets to go back as is. So that is the main point here with regards to QE. And to connect this to today and to connect this to the MMT framework, the emphasis the MMT framework has always had is that the government spending, the fiscal channel, is always more important and always has been more important. Even during the QE years, even prior, it's always been the fiscal channel that has been the driver of economic activity as the first cause, if you will. Why? Because of this whole idea that it's adding the net worth to the private sector, and the private sector uses that to leverage up the business cycle, and the business cycle expands and contracts within its own parameters, but it's always the offset of that government spending that is the first cause allowing that growth to occur. So when we got to the point where the Fed started to raise interest rates and started to roll down QE and start to enact QT, all we're doing is reversing this step. We are adding treasuries back into the private sector, removing reserves from the private sector, but no substantial change played out in terms of the net worth, minus the fact that during that time frame, especially April 2022, deficit spending ground to an absolute halt. For a short amount of time, we actually had a contraction in the change in the rate of change of deficit spending, effectively causing a surplus in real terms during that time frame. Now, that reduced the net worth momentarily, and that is why 2022 played out bearish. Once the rate hikes kicked in, though, what it did is it re-increased, because of that additional interest income, the acceleration of the net worth of the private sector, and the private sector was able to pick up where it left off at the end of 2021. And that's why so many in the mainstream got 2023, or really 2022 and 2023 wrong. It's because of that view and that slight framework shift that allows you to see the difference of the impact. So that is the main kind of applied MMT idea here when it comes to QE, and why a lot of the discussions right now in the Twitter sphere and on social media still continue to get QE wrong. It was never monetization of the debt. It was just a transformation of the sort of assets that are out there that had very little material change on the private sector. All right, that's it for the QE part. But before you leave, quick update. Monday during the live stream, we are going to be going over the hour-and-a-half takedown that Bob Murphy did recently over on Mises Media of the MMT documentary. Make sure you get subscribed with that notification bell turned on. That'll be Monday night during the live stream. We'll have some clips for that. Bob covered quite a lot, got quite a lot wrong. We're going to correct him. We're going to go into a lot of detail on that. So make sure you get subscribed with that notification bell on so you get alerted when we go live with that live stream. And if you are an active trader, active investor, you would like this sort of research and analysis, you want access to all the tools that I have discussed in the past on this channel and shown on Twitter, make sure you head on over to appliedmmt.com to sign up to get access to those. And if you're just looking to keep in touch and get an occasional free article or two each month, make sure you just drop your email in there as well. We have a free newsletter that comes out every once in a while, so make sure you sign up for that. All right, that is all I have for tonight. So until next time, good trading, everyone, and we'll talk to you then. Bye-bye.